Good morning. We're live. We will give an extra minute for people to continue to log on. We'll start in about a minute. Thank you. Okay, good morning. I think we'll get started, and welcome to everyone attending online this morning. Thank you for joining us today for the 2019 year-end webinar. We have a few topics today that we think will be of interest to you. My name is Rich Flanagan. I'm a tax partner with Maillie LLP, and I'll be serving as the moderator and part-time contributor for today's event. A few housekeeping items before we get started. CPE credits. We are offering CPE credits, 2 hours of CPE for today, an hour and a half tax and half of other. If you need the CPE credits, you're required to listen to the entire webinar to qualify. There will be 4 polling questions throughout the webinar that all attendees will need to complete in order to receive CPE credits. When a polling question is launched, we will give you 1 minute to complete the question. There will also be a survey at the end of the presentation for you to complete to verify your attendance. It is important that the survey be completed to receive your credit. We will email your CPE certification to the email address that you used to register for the webinar. Questions. We will be allowing questions that can be submitted online, and we will address them at the end of each of the 3 segments. We will do our best to answer as many questions as we can, but we may not be able to get to all of them with our limited time this morning. I do encourage anyone with unanswered questions at the conclusion of today's presentation to contact your Maillie representative after today's event with any questions or to address your individual circumstances. That should do it for the housekeeping items. So without further ado, we'll start off with Mary Malzita, who will be discussing issues with cryptocurrency, which seems to be a hot topic with the IRS these days. Mary Malzita is a tax manager who provides tax representation to clients for IRS and state audits, including IRS examinations, payroll tax audits, and sales and use tax audits. In addition, Mary works with the IRS on collection issues, payroll tax delinquencies, and offers in compromise. Take it away, Mary.
Good morning, everyone, and thank you, Rich. As Rich mentioned, one of my primary responsibilities with Maillie is to represent our tax clients to the IRS on audits and other areas of focus by the service. Currently, the topic of cryptocurrency and its tax implications are a major focus of the IRS. The value of cryptocurrency has grown exponentially since the dawning of crypto in the 1990s. This significant increase in value has the eyes of the IRS in that the service feels they have not seen taxable transactions reported on their returns. This presentation provides a basic overview of cryptocurrency and transactions which trigger a reportable transaction for your tax return. On screen, you will see a very broad definition of virtual currency. In layman's terms, what crypto is, it's a type of currency that uses digital files as money. In some environments, it operates like real currency, but in the United States, it does not have legal tender status. Cryptocurrency is a type of virtual currency that utilizes cryptography to secure transactions. Cryptography is a method of protecting information and communications through the use of codes. The way crypto works is it is stored in ledgers. The most basic ledger is blockchain. And when you purchase crypto, you purchase it through an exchange such as blockchain. The most common currencies include the Bitcoin, Ethereum, and Ripple. Most recently, Facebook has announced that they will issue their own payment-based cryptocurrency, which currently is known as Project Libra. A staggering fact is that there are currently 18 million Bitcoins in existence. Your next slide shows the timeline of the birth of cryptocurrency. So in the 1990s, DigiCash was born. And DigiCash was the first type of crypto that existed in the world. You can look at the timeline. One of the most famous transactions involving cryptocurrency was there was a man in Florida in 2010 that purchased 2 pizzas. He used 10,000 Bitcoin to purchase these pizzas. Today, that 10,000 Bitcoin would be worth $100 million. You can see the way that crypto is growing and the value of crypto, why it has caught the attention of the IRS. In 2014, the IRS issued its first guidance in a notice that gave some guidance to taxpayers on what they need to look at when reporting transactions on their tax return. In 2017, one Bitcoin hit an all-time high of almost $20,000 value for just one coin. In 2019, the IRS has issued additional guidance to taxpayers. Also in 2019, the IRS has really attacked this issue and sent out 10,000 IRS tax notices to various taxpayers that they've gotten information on that they know have cryptocurrency and related transactions that are subject to tax. So if you have cryptocurrency, what triggers a taxable event? Some of the most common taxable events that should be reported on a tax return are coin to fiat sale. What that means, coin is just your legal tender. So if you have fiat, let me back up, fiat is cryptocurrency. So if you have cryptocurrency and you're selling it, this is a reportable transaction. You have a gain that should be reported on your tax return. Also, other taxable events would be coin-to-coin exchanges, purchases made with coin, and by that I mean, let's take the example of the pizza guy. So that man back in 2010 used his Bitcoin to purchase pizza. Your Bitcoin is worth a certain value, and then when you use it to buy something else, you could have a taxable event creating a gain or a loss depending on what your value of that coin was. And another taxable event would be coin income for goods and services. That would be if you are giving cryptocurrency to somebody who provides services for you. And instead of giving them, hard cash, you transfer Bitcoin to their wallet. That would be a taxable event to the person receiving the Bitcoin for their services. So our next, we have a series of questions that help you think about if you do have Bitcoin or cryptocurrency, if you have it and you have any of these events that are on this next slide, these would create things that you really need to question and advise your tax advisor that you have these transactions occurring. So you would recognize the gain or loss if you're using your virtual currency in exchange and you sell it for real currency. You would also have a taxable transaction if you're providing someone with a service and that person pays you with virtual currency. And finally, if you exchange property for virtual currency. All three of these common taxable events that people are using the virtual currency for, these are all reportable transactions that the IRS is targeting. The IRS considers cryptocurrency as property. Many people feel that it's an investment, but in the IRS's eyes, it is property, and it is subject to your capital gain and loss tax rules. So some examples of non-taxable events would include when you initially purchase cryptocurrency with your money, that is not taxable. You are just buying property and you're going to value that property at what you purchase is at. If you transfer your cryptocurrency out of one of the exchanges, a transfer does not constitute a taxable event. Now, some of the other terminology in crypto world, the exchange is where you purchase your cryptocurrency. Some of the exchanges would be Coinbase and blockchain. If you're just moving your coin from one to the other, this does not constitute a taxable event. And when you have your coin, just kind of similar to having your hard cash in a wallet, your Bitcoin or cryptocurrency is stored in a virtual wallet. If you're moving your Bitcoin from an exchange to a wallet, you're not subject to any tax here. One of the key elements when you have a taxable event is you need to know what your basis in the cryptocurrency is. And the way you determine what your basis is, basically, if you receive cryptocurrency for services that you're providing, you would determine it at the fair market value at the time when you receive that cryptocurrency. If you outright purchase the cryptocurrency through an exchange, it's going to be valued at what you purchased it on the day that you received your crypto. On the slide, we show just a very basic calculation in determining your gain or loss. So example one, if you purchase a Bitcoin for $5,000 and then you sell it 6 months later for $8,000, you're going to have a short-term gain for $3,000. Example two, we're assuming the same facts, except we're selling it a year later. In that case, and we sold it for $10,000, we're going to have a long-term gain for $5,000. The transactions are similar to when you sell stocks or bonds and you calculate a short or long-term gain or loss. Your holding period is the same as it is with your investments. So now the crux of cryptocurrency and what you're probably all very excited about is IRS enforcement areas with this subject. So because of the way blockchain or cryptocurrency has grown since its inception, the IRS feels that they are being shortchanged, where people are making a lot of money off of this activity and it's not being reported on their returns. Therefore, they're not collecting any taxes on it. In 2018, the IRS issued a summons to Coinbase seeking more information regarding accounts with at least $20,000 in any one transaction in any 1 year, and they looked at the period from 2013 through 2015. Coinbase admitted with this request it covered 8.9 million transactions and 14,355 account holders. For those accounts, the IRS sought registration records, transaction logs, payment records, and correspondence. So through this summons, the IRS gathered the information that they were looking for, and in July of 2019, they began to issue various types of letters to taxpayers that fell within the criteria that they were looking to enforce the activity on. These different letters are shown on this slide. First notice is a 6174. This basically is a notice that's very inquisitive in nature. There is no response that required by the taxpayer. 6174A is the same type as 6174. However, it elevates the taxpayer that they are on the IRS's radar, and the IRS is aware that they have transactions that they feel might be subject to tax. The third notice, the 6173, this one is the most severe of the three notices. You do have to respond to the IRS if you receive this notice. And if you do not respond, you are subject to a potential IRS examination. The fourth notice is a CP 2000. The difficult thing with cryptocurrency is right now there are very limited tax forms that the IRS receives or that the taxpayer receives that makes people aware that they did have a taxable transaction. One of the forms that you could get is a 1099-K. Not all of the exchanges are issuing these. However, if you receive a 1099-K for transactions that you are participating in through your cryptocurrency activity, you will receive a CP 2000 notice. Again, this one you must respond to, or else you're going to be assessed a potential tax liability. One of the opening sentence on these IRS notices state that the IRS has information that you have or had one or more accounts containing virtual currency and may not have met your U.S. tax filing and reporting requirements for transactions involving virtual currency, which include cryptocurrency and non-crypto virtual currencies. If you receive this letter, you are advised to actively report your taxable transactions and correct or amend previous returns which excluded this information. In 2019, we had on your screen, you will see a Schedule 1, which will be included as part of your tax return for 2019. The very first sentence on here asks the taxpayer a yes or no question. At any time during 2019, did you receive, sell, send, exchange, or otherwise acquire any financial interest in any virtual currency? This is putting the IRS on alert that if you respond yes, you better make sure that you have your activity reported on your tax return. If not, they're going to send their fishing expedition your way. So some of the IRS has tried to put together some questions that the taxpayers may ask if they do have cryptocurrency transactions. One of the more common is, if you receive virtual currency as a bona fide gift, do you have any taxable income? No. Just like any other gift, if you receive virtual currency as a bona fide gift, you will not recognize income until you sell, exchange, or otherwise dispose of that virtual currency. How about, do you have to recognize income, gain or loss, if you own multiple digital wallets, accounts, or addresses capable of holding virtual currency and transfer your virtual currency from one to another? If all you're doing is transferring cryptocurrency from either a wallet or an exchange, and it's solely a transfer, there is no taxable transaction associated with this. If you engage in a transaction involving currency but do not receive a payee statement or information return, such as a Form W-2 or Form 1099, when must I report your income on your federal tax return? In most cases, you are not going to see any forms issued to you, unfortunately. You need to keep track of any monies that you earn through, as a job or as an independent contractor. You should keep track of this money, and you do need to report it on your tax return in the year that you earned this income. Finally, what records do you need to maintain regarding your transactions in virtual currency? If you're purchasing your virtual currency through a ledger, such as blockchain, all your activity through your purchases will be recorded on the ledger. You want to make sure on an annual basis that you download and do a save of your transaction history, so that when you do sell your virtual currency, you've got the support for what you initially paid in. So cryptocurrency, it's here. It's a really hot topic with the IRS, not only in the collections division, but also in the criminal investigation division. If you have cryptocurrency and you have had transactions, I urge you to contact your mailing representative. You would really need to try to get your returns corrected for anything that had not been reported in the past. If you're just interested in receiving more information about crypto, please contact somebody.
Okay, thank you, Mary. We do have a few questions here. Um, One question we have is the idea that these transactions are taxable new? I've dealt with Bitcoin for a few years and had no idea that these transactions were subject to tax.
It is not a new concept. Unfortunately, this is where the IRS is focusing its attention because people like yourself have had transactions and you've had gains or losses resulting from these transactions. The IRS has really pushed, getting this information out that these this type of activity is subject to tax. Um, Again, somebody like yourself who has not known this is taxable, I urge you to talk to somebody at Maillie, and we'll get you geared, on the right
And
track.
look at whether there's something that needs to be amended with a return or some other filing to make sure that they're in compliance.
Exactly.
Okay.
Exactly.
Um, One other question here. There was a question about if you were gifted Bitcoin or virtual currency, how would you know what your basis was in that gift? For when you would eventually sell it, somebody gives me a Bitcoin, I hold it, I sell it. How would I know how to calculate my gain or loss?
Yep. So your basis in the virtual currency when you receive a gift um, equals the donor's basis plus any gift tax the donor may have paid on the gift. So for purposes of determining if you have a gain or loss, your basis would be equal to the lesser of the donor's basis or the fair market of the virtual currency at the time you receive the gift. So you want to kind of keep track of both what the fair market value was when you received it and also what they paid.
Okay. And one other question, how do I calculate my gain or loss when I exchange my virtual currency for other property?
Your gain or loss would be the difference between the fair market value of the property that you receive and your adjusted basis in the virtual currency exchanged. So your adjusted basis in the virtual currency would be what you originally paid for it.
Okay. Okay. Thank you very much, Mary. It's time for our first webinar polling question. We'll give you about a minute to complete the poll, and then we will continue on with our presentation. So we'll give you about a minute or so just bear with us. Once everybody's voted, we'll continue. Okay. I think just about everybody's voted, so I'm going to close the poll now. Next, we'll move on to a discussion on state taxes after the Wayfair Supreme Court decision. Marjorie Belliati will be our next speaker. Margie is a tax manager here at Maillie with over 35 years of experience in both public and private accounting and tax business process improvement. She has expertise in a broad spectrum of U.S. direct and indirect tax areas. So Margie, we can take it away.
All right, thank you, Rich. I appreciate that introduction. The thing about cryptocurrency is every year the IRS gets these hot topics, as you mentioned, Mary, and it's always enlightening to hear about them. Yeah, I mean, there's always stuff that, like, even we don't really know yet because we don't know how the IRS is going to go with it. So thank you for that great presentation. Appreciate the information on it. Um, as far as Wayfair goes, man, I've been in the tax world for about 35 years, and I've never seen this kind of sweeping tax law changes in sales and use tax. Have you ever seen that, Rich?
No, this is kind of a landmark movement in the state in state taxation. This is going to be a landmark case for, as far as the eye can see, for as long as it's law. But it's going to have a widespread effect on many businesses and how states collect and fund their business operations. It's amazing. It's a big change. It's happening very fast, and people are wondering what impact Wayfair will really make to their business. So today we're going to take a look at the impact that some states expect.
And I think people might be surprised to see some of these things. Um, oops. Okay, there you go. Sorry about that. The interesting thing about this is look at that third column there. Revenues collected or estimated to be collected. Who would ever have thought that California is looking at $1 to $1.5 billion annually that they're saying they have uncollected. The rest of those on there, as you can see, are showing from the Government Accountability Office. Iowa and South Carolina are the only two who have done actual reportings. We included those because I think it's very interesting to see. Iowa, for example, they have been in effect, their Wayfair guidelines have been in effect for 1 year. They've collected $79.5 million in additional revenue over and above what they have collected in the past, simply because of putting in this kind of tests we're going to talk about. I mean, I don't know about you guys on the line and stuff, but that's amazing to me. In addition, they actually reported that they only registered 1,800 new, sales tax collectors. But look at that, they brought in 20 million on 1,800. That's an $11,000 average for each one of those 1,800. If in fact you were having to go back and file retroactively, there'd be a lot of penalties and interest on that. Now, thankfully, Wayfair, by its structure, is only prospective, as we'll see. South Carolina has only been collecting based on their Wayfair rules for 8 months. Excuse me. They've already collected 46.8, and they've registered 3,089 new, businesses. So you're right, Rich. This isn't going away anytime soon. This is a big thing there. Pennsylvania's sales tax rate is pretty small compared with some of these other states. We're still looking at, 200 to 300 million in revenue, and that's on an annual basis here.
So Margie, tell us about the economic environment that made it possible for this Wayfair decision.
So Wayfair, as we know, and as you mentioned, it is a sales and use tax court case. There hasn't been much activity in the noise and sales and use tax area. In fact, between 1959 and maybe 1990s, there really wasn't any activity in sales and use tax. Those rules were stagnant for a long time. South Carolina went and put in, or South Dakota, I'm sorry, enacted a sales and use tax law where they knew the law itself, and they passed it, was unconstitutional. Now, there is a method with which a state can pass a law, they know it's unconstitutional, and they'll come through and they will say, okay, within the law, we want to give up our right to pursue our normal course of action in all the courts, and we want this to go straight to the Supreme Court if the Supreme Court will take it. Well, the Supreme Court did take it, and that's exactly what happened. But you call it Wayfair, but you can see the other names that are listed there on the slide. These are all pretty big companies. Keep in mind that you cannot argue that a tax law is unconstitutional until you have actually been economically hurt by that, which means you had to have paid that tax. So these companies all had to register under South Dakota. They all had to start doing something under South Dakota before they could actually bring this lawsuit even to fruition. And if you look at it, though, in reality, is Wayfair really this new big surprise? I guess, I do view things differently sometimes in the tax world. And I kind of view it as really it's an enforcement of the use tax side of taxes. So we're going to take a look at that.
And Margie, Wayfair, became, really an issue due to the lack of any activity with respect to Congress in legislating rules about assessing taxes in this area. And it really pushed South Dakota to, to enact this law, take it to the Supreme Court, because Congress basically washed its hands of it. And for many years, which is kind of the reason why there hasn't been anything really in this area till some of those older cases, was because that the courts were taking the position that that's Congress's job to regulate this and to put out rules about when states can tax and when they can't. So Wayfair was kind of, everything coming to a head in this area.
Right, absolutely. It's interesting. I've always referred to, I think early in my career, I started referring to sales and use tax as an orphan tax. Like nobody pays attention to it until it sneaks up behind you and you get hit by something. Mm-hmm. Well, I think we all got hit by something with this. Historically, sales tax, again, like it says here on the slide, right? It's been applied to the purchaser. The seller collects it, they sell it over, they send it over to the states. It's a fiduciary tax, but use tax doesn't work that way. Use tax relies on me as the consumer. When I go to Delaware and buy something, of course, there's no sales tax in Delaware. I bring it back to PA and I use it. Under the technical rules of the law, I should self-report that, and I should, in fact, be putting that on my tax return. Now, a long time ago, the state started putting the question on your actual state tax return, do you have any undeclared or any unpaid sales tax that you need to self-declare? And generally speaking, people try to comply with that. But the vast majority of the people, as we can tell from that first slide, are saying no and not reporting anything. So money's going somewhere, right? The interesting thing about this, to your point, Rich, is that until internet sales escalated, you really didn't see what was causing that dip in the sales tax revenue. Mm-hmm. It just wasn't visible. I mean, think about how this happened. They're talking now about what, 9 some billion in revenue yesterday on Cyber Monday. Mm-hmm. I mean, that's insane, because in the past you had to walk into a brick and mortar building and buy that, and you would have paid sales tax on it. So why should we not be paying sales tax on it? That's kind of why I view Wayfair as more of a, let's enforce the real rules here.
Yeah, and let's get somebody to help collect them for us.
Exactly. Yeah.
And many taxpayers in Pennsylvania may have already seen the last couple of years, or was it last year, they would send out letters to individual taxpayers indicating that they had gotten information from third-party sources that indicated that there were tax-free sales shipped to that address. So we did see a few of those letters, and that's one of the mechanisms that the states have to track down some of this money that they were losing by getting the third parties to report where they were selling.
Right, and we're going to talk about that a little bit, because that really, Wayfair really gave life to that marketplace facilitator. So we're going to talk a little bit about that in a couple of minutes here. Thing to keep in mind is we are talking state. We always use the word state and local. We have 50 states in the United States. Do not get into this false sense of security that you're talking about 50 different rules. You're talking 10,000 tax jurisdictions when it comes to sales and use tax. In addition to that, you actually have on average 900 to 1,000 tax law changes, sales and use tax law changes a year. And if you think that I'm just kind of making up numbers here, think about the fact that when there's a sales tax holiday for school, what has to happen? Your point of sale systems have to be reprogrammed to say, don't charge tax between this date and this date. Everything has to change. How you report, your whole systems, everything has to be changed for that. That's a tax law change, right? I mean, you have to, and then you have to put it back. You have to reset. Um, one of the difficulties of everything is, as it's showing here, this example here of clothing. The states can't agree on how to do this, 100% within, one set of rules. So if you buy clothing in Pennsylvania, it's going to be exempt. Now, there are exceptions because they are talking tax law, and you cannot talk tax law without talking exceptions. But in New York, if an article of clothing is $100, you don't pay sales tax on it. If it's 110, you do. So New York, way back years ago, put a bright line test in. We just didn't call it that. A long time ago, they came up with this concept that if I look at it again from my perspective, New York is saying it's not cost efficient to collect on anything that's less than that. It just doesn't make sense to chase down the dollars on a $9 article of clothing. So that's how I view that, So.
But, Margie, sales taxes seem to have been around forever, maybe even longer than income taxes with respect to certain states. Let's take a look at when both were enacted in some of the surrounding states as well as a couple others.
Yeah, this slide here will show you when these were put into place. We use California, New Jersey, New York, Pennsylvania, and South Carolina. If you look at these two, New York and South Carolina, the only two that had an income tax long before they had a sales tax. In fact, for New York, they had an income tax for 46 years before they put in a sales tax. So again, I like tax and I like the history of it. So I look at that and I say, what happened in 1963, 1964 that caused a dip in income tax revenue that to New York that made them decide they needed another source of revenue?
Or knowing New York, they just wanted more revenue. And what is it in 1965 that made them think they needed more revenue?
That's right,
I think is the
right.
way we would phrase that.
That's true. Yeah, maybe they were doing a bunch of infrastructure. Yeah, yeah. Same thing with South Carolina. That's 29 years between those two. But other than that, everybody else has a sales tax in place first. So it's just an interesting chart to take a look at that and see how how long these have been in place. So let's take a look at why it makes a difference whether they have sales tax or not, and why don't they just stick with income tax? Well, first of all, if they just stuck with income tax, we would all know that our paychecks were being hit pretty fast. Sales tax does impact a lot broader base of transactions, and that's the one thing that they can play with. You hear about it all the time. In Pennsylvania, about 10 years ago, they tried to tax the hard copy tax returns that CPA firms were providing to their clients, saying that we were delivering a tangible personal property, and therefore we should pay sales tax on that. That actually got snuck in and passed and then got repealed rather quickly. But they tried to do that with computer services too. You're using a software to do your tax returns. Your attorneys are using software to develop your wills and estate plans and stuff. So why shouldn't that piece of that bill be taxable? So they have always tried to find ways to come out with more and more broader spectrum of what they can tax. On the income tax side, though, it's your income, right? I mean, you're getting taxed at your gross wages and you're getting taxed on any other income, but it's not the gross amount. I mean, you are getting some net on, you can take off, well, in Pennsylvania, you can't take losses, but in New Jersey and New York, you can. So there you go, guys. But the fact is that since the mid 70s, as that last bullet point states there, sales tax has actually accounted for more than 50% of the revenue in almost all of the states.
Since states, generally have both a sales tax and a personal income taxes, how do those rates compare?
Well, that's a great question, and you might be surprised to find out the answer here. But if you look at this next slide, you can see in that third column there with the current rate. So this current rate average state and local, what that means is that is the state rate, which is generally a flat rate, plus the average of any local rate. That's how I'm coming up with those percentages there. New York is a good example. New York state rate is a flat 4%. However, the average local rate is 4.875. Now, they're one of the few states where the average local rate is actually higher than their state rate. So I'm guessing that if you live in rural New York, you're paying closer to 4%. But if you go to New York to shop, you're paying the 8.875%. You can see how that reconciles or looks at the top rate for the income tax. Let's continue with the New York example. Last time that was updated was 2012, and the current top rate for New York is 8.82%. So that's pretty much a break even. Not much difference between sales tax and income tax there. If we jump up to California, that's not the case there. California last changed their sales tax rates in 2017. Their combined rate is an average of 8.44. Income tax, the last time it was changed, was 2013. Now, I do have the top rate there at 12.3. There is a 13.3 if your California income is over $1 million. I used the 12.3 because I felt that that was probably more reflective of a true rate differential. If you looked at that line, you would conclude California loses big time on sales tax because there's a rate differential of a negative almost 4% there. So one of the things I think that happens with this is that by increasing your sales tax rates, again, it's kind of, to me, it's a backdoor way to increase revenues. What does that do, though? That increases the tax burden on everybody in those states or everybody who shops in those states. But it's kind of a sneaky way because you don't see it until you actually pay for something.
So Margie, let's see what the impact would be on a hypothetical situation.
We're going to take this example, which is purely hypothetical. We're going to say, what would happen if we had gross sales taxable? Now, we have more sales than $1 million, but the taxable in each case is $1 million. We're going to apply our average rate. We're going to come up with our sales use tax due. Now, we're going to use net income, and we're going to assume this is an S corp or a partnership, so it's getting passed through to the whoever the owners are. We're going to use $500,000. Now, on $1 million in sales, that's a 50% gross or net profit. That would be very nice. I would love that if that's what I was doing in a business, but it's not very realistic. If, in fact, we used a more realistic percentage, though, you would see that variance in the last column drastically increase. So I wanted to keep it close to kind of see almost where a break even would be. And you looked at our top rates and we came up with our income tax due. That last column represents the difference. And in every case, sales tax exceeds income tax. Let's take a look at how this impacts everything overall, though. Again, let's say I'm an S corp and I'm paying sales tax or collecting sales tax on $1 million in California. And then on my California individual return, I'm paying $61,500 in income tax on that $500,000. That means that my S corp contributed a total to the revenue of California, a total amount of $145,900. It's a lot of money. Now, if we look at what the sales tax is, sales tax of $84,400 is 58% of that total. And if you do that in each case going all the way down, you will find that New Jersey, in this case, we would add $111,000 in income, of which the sales tax is 60%. New York, we end up with our sales tax being 67% of the total revenue contributed by this entity. Pennsylvania, sales tax collected $63,400, income tax $15,350. Total revenue $78,750. Doesn't sound like much when you're looking at New York at $145 with those same numbers, right? But guess what? Your sales tax now represents 80% of the revenue that the state is collecting from that business, that entity. So when you look at the numbers, you can see that these examples are showing why states are trying to find what I call backdoor ways to collect more sales tax. It really makes sense to go after the sales tax as opposed to the income tax Plus, like I said, it gets less publicity, generally speaking.
Margie, it certainly does seem like the changes to the sales and use tax can certainly have a bigger impact on a state's budget than a change to the state's income tax. Based on what I'm hearing, a lot of businesses or some businesses don't think Wayfair will really have an impact on them. What are some of the things that they should be revisiting in light of the Wayfair decision?
Well, at a minimum, Wayfair should make everybody take another look at their businesses. I mean, really, it's not just the transactional side, but now you need to know what your business models are, and you need to know them from a sales and use tax perspective, which is a whole different view from whether or not I want to go into a marketplace or not go into a marketplace. Maillie be able to assist you in making some changes to business models that, wouldn't have a significant difference on your overall business, but could potentially help save you some tax dollars when it comes to sales and use tax. One of the things you have to do is you have to look at what is Nexus.
What are some of the questions a business should be asking of their business about the business, even if they've been asked before? I mean, historically, there's always been questions that we've asked to determine whether sales tax or income tax. What should we be looking at these days?
Well, the biggest one is that second one, and that is, do you have Nexus as it is now defined? That is very important. Sales tax is one of those areas where you cannot do a sales tax analysis 1 year and then put it away in a closet for 5 years. You just can't do that anymore. You could have years ago, but you can't. The interesting thing about Nexus, everybody talks about, what is Nexus? Do I have Nexus? Nexus is a legal term. It's not a tax term. It's just a legal term that allows a state to say that you have a connection, that they can now reach out to you and say you have an obligation to file a tax return.
A sufficient connection. That's always been the arguing point. What was sufficient enough for that state to be able to assess whatever tax you were dealing with?
Yep, and historically, when you reach the Nexus threshold, has always been easier for sales tax, and that slide right before shows why that is. Because if I can collect, 6% on $1 million, I'm much better off doing that than I am collecting 6% on 500,000. I mean, you end up with it being, a big difference here. If you have sales tax nexus, you may not have income tax nexus. So if you have done an income tax nexus in the recent past for your company, you should really take a look at sales tax, and you should make it a priority to look at it, because generally speaking, if you have income tax nexus, you probably have sales tax nexus. Don't get all panicky. Doesn't mean you have to jump up and register, but it does mean you should ask some more questions. You should take a look at things. You should be asking questions like of what are on these next couple of slides. Do you sell anything that is taxable into any jurisdiction? And if you do, have you relied on physical presence to not have to comply with any kind of sales and use tax? Do you provide any services? Now, this is one where you really have to think about this. What if I sell bicycles? Okay, that's nice, but that's tangible personal property. I'm generally not going to have to worry about it for sales and use tax. But what about the services? What if I do the annual maintenance on it every year? What if I sell a warranty with it? So you really do need to look at it from a different perspective.
So Wayfair has really, to some extent, expanded the nexus definitions that'll be used in determining, whether your company should be subject or collecting or whatever. But what are those items that are highlighted that may cause nexus because of the Wayfair decision?
Well, there are a few of them, Rich, but we're going to take a look at 3 of them today. We're going to speak to 3 of them. And the first one we're going to speak to, of course, is physical presence, because don't get too complacent with this. Physical presence is still there. It's still in the law. It means it's not the only test anymore. And that's a very big distinction. Take a look at how Pennsylvania defines physical presence if you're hosting a web-based link. I'll give you a second to go ahead and read through that language, which is lifted right out of the PA recent webinar that they had explaining it. Now, I do mention there that they have 7 different situations they can count as physical presence. We're only listing 2 there. Okay. Couple of things about that. Okay, if I have Margie's upholstery service, and I live and work in Pennsylvania, and my computer is in Pennsylvania, and Joanne Fabrics wants to put a link on my website, and you go to my website and you click on Joanne Fabrics and you buy something, Joanne Fabrics gives me a 2% kickback. That's what they're trying to capture here. Okay, if I have a computer and everything's on my computer, maybe my link is in Pennsylvania, but what if I use the cloud for everything? What if I have nothing on my actual computer? Where's my link at? Pennsylvania doesn't define that. And the thing here is that it's not just Pennsylvania. Many times these sales and use tax laws are put out there. They're put out there what I call deliberately vague, and they build it by way of court cases. That's really how it is, the terminology and stuff, and therefore the enforcement gets defined by the courts. When people challenge it, then the states come through and say, okay, we won in this case, so now we can say, this is how you have to do it.
It gives them more leeway, and it doesn't really nail them down specifically to any one situation or answer, depending on the situation. It gives them more leeway. It's not a black and white. And, in a lot of cases, it may not be worth litigating.
Right.
And, the answer becomes by default because you don't want to spend the money suing the state or whatever remedy they may have.
Yeah, I often say that the states didn't win this case. The client just couldn't afford to win. They couldn't afford to fight the case. So the states didn't win. They just didn't lose.
And sometimes that's enough, and especially in this area when you're looking for.
Absolutely. Yep. So physical presence has historically been required. And this is based on these two court cases, which you've probably heard a lot of in the last few years. Notice one of them was a mail order and one of them was a retailer. In both cases, the decision was that they didn't have physical presence, so there's no sales and use tax obligation. Seems pretty cut and dried. If you think about it, you would generally expect physical presence to be much easier to identify as to where a sales takes place and where the product might have actually been used. This is really what's called the dormant commerce clause, and it is in Article 1 of the U.S. Constitution. It is U.S. Congress who has the right to say who can tax, which states can tax interstate commerce and international commerce, quite honestly, because waiver doesn't just impact U.S. companies. Anybody selling into the U.S. is impacted. This is not a border-only tax. This is a worldwide tax. Of course, Wayfair went ahead and made a change to that, threw everything upside down. But really, what did they do? They acknowledged that the sales tax laws are very antiquated. Business just doesn't occur the way that they did anymore.
So economic presence was the U.S. Supreme Court's gift to everyone deciding the Wayfair case, is what you're saying. It opened the door.
That's right. That's right. Once it was decided and the opinion was issued, then everything changed. And boy, has it been changing. I mean, we're going to see in a few minutes here how fast things have been changing within this world now. How do you know if you have economic presence? It actually can be difficult sometimes to make that final conclusion that that's what you have. But you have to take a look at the biggest thing that's defined is where is the benefit received. In my example earlier, if I go to Delaware and buy something and bring it back to PA, I'm obviously getting a benefit for it in PA. So that's kind of easy to see where the benefit is from. Gets more difficult when you start talking about things that are electronically transferred. If I in fact had my Margie reupholstery service and I was using the cloud, well, where's that benefit being received? So there are rules around sales and use tax which limit sales and use tax to be assessed within a state's geographical boundaries. That boundary ends at the international airspace. So it ends at about 32,000 feet. So I've successfully argued a case once about that. So but it ends at international airspace. So where is this going to end, right? The cloud, who knows? I do want to remind everybody, because I hear a lot of this out there, Public Law 86272 does not apply to sales and use tax. It has never applied to sales and use tax, and as of right now, will not. Congress has the ability to change that, but as of right now, that is the rule. Okay,
What,
it only applies to income tax.
do you want to just give a little back 86272 for
Oh,
those that may
sure.
not know the lingo?
Okay, sure. So Public Law 86272 came in 1959. It was actually put in place to avoid railroad companies and stuff from being able to charge different transportation rates for individuals who would buy their ticket in one place and go to another place. So they were saying it was a disadvantage. Like if you were in California and you wanted to go to Illinois, if you left California, you were paying more for that one-way ticket than you were from going from Illinois to California. So it's actually put into place as part of that to try to regulate that border crossing tax. But they did say it only applied to tangible personal properties, only to the extent you could pick it up and move it. That's the only thing it applies to. And basically says that if you don't have physical presence and you're not selling tangible property, then you don't have to have income tax
And your
nexus.
activities are minimum in that
Right,
state.
right. They're at a minimum, right? Yep.
They're limited
Yeah,
more to solicitation within the state,
that's right.
and you don't get involved in any warranty repairs or any of the things that
That's right.
most salespeople would do. If it basically 86272 said that if you're soliciting sales as a pure salesman,
Hmm.
that would not be enough
Right.
to create an income tax liability in a particular state. It wouldn't create that nexus or that connection with the state for that state to be able to assess an income tax
Correct.
within that state.
Correct.
Essentially, that's when you boil it all down, that's kind of where you get to with the
Right.
86272.
Now, what happened in 1959? What happened in that period? Mail order catalogs. That was the
Okay.
birth of the mail order catalog world. Reader's Digest is one of the cases that brought this up. The state, Illinois, assessed that they were getting a benefit in Illinois because their garbage collectors had to pick up the thrown out Reader's Digest magazines and stuff, and that their garbage dumps were collecting them. So therefore, Reader's Digest was getting a
Had property.
benefit. Yes. So believe it or not, that ended up being a sales and use tax case, and Illinois won that case. But they lost it on the income tax because of this.
Because of
It's just
86272, it wasn't.
solicitation. Yeah, there's nothing, right? Yeah. So again, it's easier to get a sales tax than it is to get an income tax nexus. You do have to look at bright line test, and this is one of the big things that South Dakota did. What they said was, you know what, we're just going to say basically what New York has been saying for years. They were going to say, if you're not selling more than 500,000 into our state, we're not going to chase you down. That's basically what they're saying with this. So we call those a bright line test. Some states have actually put in a dollar amount, and some states have put in a number of transactions amount. We're going to go ahead and take a look at some of these bright line tests. So,
What are some of the bright line tests at these states? And again, the bright line tests are, in some respects, it's good because it gives you a firm target as to whether you're in or you're out. I mean, it kind of reduces some of the guesswork for good or bad.
it
In this
does,
area.
and it does exactly, yes. And you can see that we list here all these are prospective because under the law it has to be prospective. What I want to point out is I have PA marketplace seller there highlighted. I want to make sure I don't forget to say anything about that. PA put into place what we said earlier, this marketplace facilitator, where the marketplace, if you were an Amazon seller or something like that, if you exceeded $10,000 in sales in Pennsylvania, then you had a reporting requirement. Well, effective September 30th, 2019, that has been suspended. Now, I have it highlighted because it was not repealed. What that tells me is, in my experience, they want the flexibility to be able to dust that off and bring it back if they decide that they need, excuse me, sorry, just adjusting my headset. But if they decide that they need to enforce that or it's going to help them in any way, it is much easier to dust the cobwebs off of one that's suspended than it is to get a whole law passed again. Again, think of it as you have elections, you have change in congressional makeup, They don't have to go through everybody having to agree to it or vote on it or anything like that again. They just say, we're going to unsuspend it. So that's important to note on that, because that's a $10,000 threshold. But you can see all the others are up, 500,000, 100,000. New York, to show you how fast these things are changing. New York started out at 100,000 and they recently changed it to 500,000. So that's how fast things are changing. The number of threshold, the number of sales threshold, that's really important. South Dakota was the first, of course, to put that in. They said if you had 100,000 in revenue or 200,000 transactions
200.
in a calendar year. And one of the things you have to keep in mind is, how do you define a transaction? Well, it's sales and use tax. It's not defined. So that is not 200 customers. Basically speaking, right now, until we get additional guidance, if you lease software on a month-to-month basis to a client or a customer in South Dakota, and your revenue exceeds 100,000, you have Nexus. If you have enough customers in there that your monthly, month-to-month lease adds up to 201 monthly leases, you have Nexus in there, even if you don't hit the $100,000 threshold. So I think the important thing to keep an eye on will be defining that threshold and what does that mean.
It sounds like every business has to now track these rules by every location where they might have customers or sell something into. Additionally, it also looks like they need to know their business models from a sales and use tax perspective. Are there questions they can ask internally to help them get to the detail behind their sales numbers?
And we certainly want to be as helpful as we can to our clients and anybody out there who's trying to wrestle with this. This is not an easy world to try to swim through and figure it out. So for economic presence nexus, these are some of the questions you can ask. Again, do you sell into any taxable items where you haven't registered before because you thought you had didn't have physical presence, or because you just didn't know what the rules were, or because you changed employees and whatever, right? Again, do you offer services? Warranties are a big one. The states are going to start going after warranties and repairs because they're easy to identify in your contracts. You have a written contract for that. Do you contract out services? Some states define economic nexus as hiring an independent contractor to do work for you. So therefore, you may in fact have economic presence nexus if you are just having an independent contractor put the furniture together in the state that you sell the furniture to. Has the tax jurisdiction you would sell into adopted a waiver approach? And if they have, do you have any idea what the thresholds are? The importance of trying to see, again, from a sales and use tax perspective, it takes a different view of your business world. We talked a little bit already about economic benefit and how do you define that. So you can see some of the ways that you can do this in this slide. Obviously, where your customer is located, you would think that would be pretty obvious. What happens if you sell to, let's say, you sell to Walmart, and Walmart stores the items in Pennsylvania and then sends them out to distribution centers in 3 different states. And then from there, let's say there's no distribution center in Illinois, so the Michigan distribution center sends some of their supplies over to Illinois. Where does this thing end up? When is it considered taxable? So economic benefit may not be as easily to define as we were thinking. If you can't decide where the benefit is, you do have other methods, and really they say any reasonable method. The key here is once you put a method in place, no matter what you do, you need to be consistent, and you need to treat it consistently, not just for sales and use tax, but for any other taxes that you might be dealing with.
Okay, it's about time for our second webinar polling question. Again, we'll give you about a minute to complete the poll, and then we'll continue on. Let's see. Okay, so it should be open now. I'll give you about a minute or so. Okay, it looks like everybody that's going to vote is already voted, so I'll close the poll now, and we'll get right back to it.
All right, thank you. So the biggest thing about a marketplace facilitator is that they have to have an e-commerce platform. In addition to that, they have to actually engage in activities that are actually approved and defined as state laws. Two examples you see there, Amazon and eBay. If you in fact have a website that merely advertises goods for sale, but you don't actually handle any part of the transaction, so in my example earlier, the click through to Joanne Fabrics, my Margie's reupholstery service isn't doing anything other than providing that link, I would not in fact be considered a marketplace facilitator. How do you know if you are a marketplace facilitator? Again, you need to look at your activities, and you need to look at them now under this new law. One of the big questions you might want to ask is, do you have inventory on consignment? Amazon does that on a regular basis. So, you may be too. Some of the bright line tests for marketplace facilitators you can see here. Most of them so far have not put in a number of transactions. It's purely dollar driven. We put Pennsylvania Marketplace on there again because it's been suspended, not repealed, okay? Hawaii we threw in there, again, I just found it fascinating. Hawaii has a marketplace facilitator starting January 1st, 2020, receipts threshold of 100,000, then you can either collect and remit the sales and use tax or not do anything. Now, I suspect that's a miscommunication, but right now that's the way the law reads. So if you're in Hawaii and you're not marketplace facilitator providing forum sellers lists, which I assume to be customer lists, effective January 1st, 2020, the 100,000. But here you elect to be deemed the seller and collect or remit, or look at that reporting requirement. You have to put a notice on your form. You have to give a written notice to the purchaser at the time of sale, indicating whether or not they paid sales tax on that. Then you have to report each sale to the Department of Taxation. Now, this tactic really does is it allows the Department of Taxation to go through and basically do what I call a reverse look at sales tax. They go directly to the customer. Oh, look at this. You bought 200,000 worth of new furniture from a manufacturer in Tennessee and had it shipped over to Hawaii. You didn't pay any sales tax in Tennessee and you didn't report it on your tax return, but look what we have here. So, it's very interesting to see how they're stretching to do these. So,
Since the states appear to be at least trying to line up the rules for economic presence and marketplace seller, can we expect these kinds of changes to continue?
yes, I think we can. I do think that the fact is that once the states see a benefit of these bright line tests, I think they're going to go after it full speed because it's just what makes sense. I mean, it's so easy, much easier to, even for them to enforce. Can you imagine how hard it is for us as taxpayers to comply with these rules? Well, really, it's just as hard for the agents to figure it out too.
Mm-hmm.
So,
And all the states are hungry for tax money. They need funds for their budgets. So I guess to the extent they see it's working somewhere else, they're more than happy to join the bandwagon.
right? Why not?
Could we still see? I mean, we talked a little bit earlier about the legislative, the failures of Congress to address a lot of the things in this area. I mean, could we still see Congress step in to either nullify or change the Wayfair decision? Because Congress is still the one that has the right to decide about the Commerce Clause and Due Process Clause activities and whether they'll be allowed. Ultimately Congress has the authority and the ability to change all of this.
Yes, they do.
Wayfair kind of, South Dakota pushed Wayfair to the point. So that's kind of where we are. But I guess Congress still could make tweaks or change or even nullify pieces of Wayfair by enacting legislation in the future.
Yeah, in fact, Congress actually has introduced a bill called the Business Relief Act of 2019. I wouldn't bank on it getting passed, though. I wouldn't like put any money in the bank on this thing. The idea there is they're actually trying to update Public Law 86272 to extend it to services, tangible personal property, which it already covers, and to specifically state that you're not required to have physical presence. As of right now, the language in that still only applies to income tax, but they certainly could extend it to sales and use tax because it's interstate commerce. I just wouldn't, again, like I mentioned there, 2020 is an election year. We saw a huge tax act passed in 2017. Here we are almost in 2020. We don't have a Tax Technical Corrections Act. And that's simply because the rules of Congress require a bigger majority to pass a Tax Corrections Act than it does to pass the original act. So I really don't see anything happening in Congress. Certainly the fact that the US Supreme Court said we're basically erasing the 92 and the 67 decision, but Congress hasn't done anything for 40 years, so I'm not sure they're going to feel like any real urgency to do anything right now.
And I wouldn't be advising anyone to hold their breath on the Technical Corrections Act before the end of the year. I mean, we're already getting within 3 weeks of the Christmas. Although Congress has historically enjoyed passing legislation on Christmas Eve and then running out of town, leaving us to deal with 8 days till the end of the year to do something with it. But this year, I don't think that'll be the case. I think we have what we have at this point. We just move forward with what we have.
I swear they like to see how fast we can actually figure out what they wanted us to do. So the big question, of course, then on everybody's mind would be, well, if it gets overruled or if it gets changed, I'll get my money back, right? Yeah, no, you won't. History shows that there is no court in the land that will approve the refund of money, even on a safe harbor filing. You get some percentage of it back, and it makes sense, right? I mean, they don't want this money isn't collected and sent into some fund just in case somebody sues and it gets overruled. It's already spent. So you'd be bankrupting the states. But it's interesting to mention, Rich, you and I were talking about this whole thing. We were talking about the Annenberg versus Montgomery County case a long time ago. It actually started in 1996. It was settled in the year 2000. And I didn't live here at the time, but you did. So do you give like a recap?
This was a little earlier in my career, but I had more hair then when this was an issue. But basically, the issue in the Annenberg case was related to the constitutionality of the old personal property tax that existed at the county level a number of years back. Some of you may remember it. It was a tax. I think it was 4 mils on stocks that you own. So you may remember, if you're in my generation or my age, those long, I believe they were green forms where you had to list all your stocks, all your mutual funds. And we subscribed to services that would tell us how much was invested in Pennsylvania companies and how much wasn't, because the crux of this case was that Pennsylvania allowed an exemption for the personal property tax if the company was registered and did business in Pennsylvania and paid the capital stock tax, which capital stock tax is now long gone too. So, but a little historic fact there, that the problem with the tax was that the tax was not found to be.
You can just read that if you want.
The tax was not found to be constitutional, unconstitutional, but the exemption that allowed you to not pay tax on the Pennsylvania corporation value was deemed to be unconstitutional, and they were able to sever that piece of the law, and it kept the law intact. So the law itself was not unconstitutional. It was the exemption that was unconstitutional. So they carved that out because, quite frankly, if they didn't carve that out and the tax was considered unconstitutional, they would have had to refund 3 years worth of tax to everybody that paid the tax in Montgomery County. I believe the amount was about $68 million.
Wow.
It was close to $70 million that Montgomery County would have had to float a bond just to refund taxes to those particular taxpayers. So they came with a workaround, and basically at the end of the day they came up with the fix was that they had to charge tax on all stock. You couldn't give the exemption. That's what the fix was. So basically, Montgomery County came out and said, "Look, we won't go back for if you don't go back for the refunds, we won't go back for the tax, and we'll call it a day." And I remember back in whatever year it was that when they sent out the forms, you could elect to, waive your ability to
Right,
um, request a refund,
right.
and on their half, they wouldn't assess the tax. So I guess the point here is that municipalities, government agencies will do everything they can to contort whatever they can so that they're not left with a $68 million hole in their budget that, like Margie said, the money wasn't just
Yeah,
sitting around.
yeah.
It was already in a bridge or, in somebody's, you know, uh, project for the particular neighborhood or whatever. So it would have been a real hardship on a public policy
Mhm.
point of view for Montgomery County. So that was kind of the outcome of that. So that
And
was.
and that was just a county. I mean,
Mhm.
so now multiply that exponentially by a state, sales tax or something, and that is the reason why you will generally not get refunds on these types of things. There are a couple of other types of remote and internet seller nexus. We're not going to go over them today. We are just supplying a quick highlight of them real fast here on this one slide. We did talk a little bit about click through with my example of the, um, Marge's reupholstery service, but just know that there are other remote seller nexuses out there. So it is a whole different world now out there with this. We have about 5 scenarios within the slide deck we're going to take a look at. We're going to go quickly through a couple of them. When you get the hard deck through the PDF, you'll be able to take a look at all 5 of them. And if you have any questions on any of them, please feel free to email me. More than happy to touch base with you, more than happy to go over any of the examples with you or anything else in the slide deck, as a matter of fact. So here are very simple, you're headquartered in Pennsylvania. Your employees go into New York and New Jersey. You sell office furniture directly to business users. All your offices or offers are approved in Pennsylvania, shipped for in common carrier. You have sales tax nexus in each state. You would have sales tax nexus in New York and New Jersey if you met their thresholds. Your sales force enters the states, the sales are directly to the end user, but you wouldn't for PA because we're going to assume here that everything is sold outside of PA. So we're going to skip scenario 2 here just for time's sake. We're going to go to scenario 3. Your business is headquartered in Pennsylvania. Employees physically go into New York and New Jersey. You sell office furniture directly to wholesalers. All orders are approved in Pennsylvania. Your product is shipped via company-owned vehicles. Do you have sales tax nexus in each state? Yes, if you meet the threshold for New York and New Jersey. There's the reasons why. If Salesforce enters the state, they sell to wholesalers. Now, a lot of you are probably saying, no, I don't have any nexus because I'm selling to wholesalers. Here's the fine line definition here. You do have nexus for sales tax. You just don't have to collect anything, but you have to collect exemption certificates because they're wholesalers. So whether it's a resale certificate, a reseller's certificate, or a wholesaler's exemption certificate, you need to have something on file explaining why you did not charge tax on that taxable transaction. Again, if you sold them all outside of PA, you wouldn't have any PA nexus in here. For scenario 4, your business is headquartered in New York and you sell clothing and accessories into Pennsylvania. Don't have any physical presence in Pennsylvania. Here's the makeup of your sales. So, do you have sales tax nexus in each state? Again, off the top of your head, or your knee-jerk reaction might be, no, I don't. But let's take a look at it. For Pennsylvania before Wayfair, you would have had no physical presence, so you'd have no sales tax. Purchaser would, in theory, pay use tax on the accessories and the jewelry. But post-Wayfair, Pennsylvania says if you have total sales, taxable and non-taxable, into Pennsylvania of 100,000 or more, you have sales tax nexus in Pennsylvania. Our total taxable, non-taxable sales add up to 130,000. So therefore, you do have a sales tax obligation in PA, but it's only on the taxable sales. The 100,000 is the first level test to determine if you have a PA sales tax compliance thing. Keep in mind here that your taxes are paid on the full amount of your accessories and clothing, not just 30,000 in excess of the threshold. New York, both before and after, you didn't deliver anything in New York, so you don't have any sales tax nexus in New York. For scenario number 5, you're headquartered in New Jersey. You provide access via the internet to various sellers of items taxable and non-taxable into Pennsylvania. Again, you have no physical presence in Pennsylvania. 75,000 of direct sales of household goods and 35,000 through the third parties that you're allowing to use your platform, your internet platform. Think Amazon, eBay. Do you have sales tax nexus in each state? And this will speak directly to Wayfair. Again, before Wayfair, none in Pennsylvania, same reasons. Post Wayfair, you have 110,000 in total sales. You do have to, as the marketplace facilitator, you do have to include the value of all of the sales of everybody you allow to use your platform to complete an e-commerce transaction. So therefore, you do exceed the threshold. Again, you need to take a look at your business models from a sales and use tax perspective, because I think this is going to change the way some of you see these things. New Jersey, again, no, if you're not delivering in New Jersey, then you don't have that. Okay. It's important to keep in mind that all of these bright line thresholds are tests. And once you meet or exceed them, 100% of your taxable transactions are taxable. So for example, in PA, we have 110,000. That includes everything subject to sales tax and not sales tax. We're only exceeding the threshold by 10,000. I have heard people say they have been reporting only the 10,000. Well, that's not how it's supposed to go. We are supposed to take the total amount that's taxable. In our scenario 4, we had 75,000 of clothing, 35,000 of accessories, and 20 in jewelry, giving us a total sales of 130,000. But our accessories at 35 and our jewelry at 20 added up to 55. So 55 is what you end up paying tax on, not the 30,000 in excess. It's an important distinction there.
Margie, that's a lot to take in, and you have to do this for every tax jurisdiction. I know we've been speaking about the state tax impact of Wayfair, but keep in mind that there are also local sales and use tax jurisdictions out there that you also need to keep track of.
That's
Pennsylvania,
right,
we have
Rich,
a few, but
Oh,
there
yeah.
are some. California has, every county, and
Louisiana has parishes. In Florida, if you're a retail store, if you're a retail store in Florida and you're a chain, every location requires that you report the sales from that location, your stores in that jurisdiction to that jurisdiction. So you're really tracking.
It's a big burden on tracking your sales and knowing exactly where everything left and where everything went.
Right. And that's one of the reasons why the U.S. Supreme Court, when they ruled in favor of South Dakota, one of the reasons that helped them get to there, I believe, is because South Dakota said, we have no interest in going back and looking backwards on this. We only want to look forward. We understand it's going to be hard. They also said that we will help build in ways to reduce the cost for small businesses to comply with this. And that's part of what we're going to look at when we talk about, well, what are our next steps here? How do you know what your revenue streams are? I'll tell you the easiest way to know is look at your general ledger. If you have a general ledger that says sales of widgets, sales of furniture, warranty, installation, freight, those are all revenue items. Those are your revenue streams. That's the easiest way to think of it. You have to look at, do you have new customers? If you do, where is it being delivered? Where's the ultimate benefit being derived from this? Do you have any new products? Any new services? Do you make internet sales?
How would you go about identifying your revenue stream? I mean, if it's office chairs, then that's my revenue stream, right?
Well, this is taxes, Rich, so it depends. That's not what the answer to that on everything. If you are making, office chairs, are you making all the pieces at your factory in Pennsylvania? Are you making some of them overseas, and are you buying them overseas and you're assembling them here? Are you assembling pieces here? What about the hydraulics on the chairs? Are they done here? Are they done by somebody else? Maybe a car dealer is actually a subsidiary of a car dealer is actually manufacturing those and shipping those to you. So there's all these things you have to look at, not from a what am I selling, but how does sales and use tax get impacted because of what I'm selling? You want to take a look at what your compliance options are here. We have listed here this Certified Service Provider Program. I want to mention to you and make sure you understand that this is a direct result of Wayfair. This is basically what South Dakota built into their tax law when they passed it, saying they will provide some kind of relief to small businesses. But this is a very new program. It very much is being tested. As Mary said earlier, that in the Bitcoin stuff and cyber currency, I mean, all this is being tested. They're trying to figure out how to get that reported. It's the same thing here. Trying to figure out how to get this reported. How do we get this information out? Some states have actually approved some certified service providers. The Supreme Court, when they approved Wayfair, again, in part, they did it because South Dakota built this resource in. It is meant to help reduce the administrative and compliance costs. Not all states can actually can use these though, and not all state, in a state that has it, you can use them, but only if you don't have physical presence. So in other words, if I'm a Pennsylvania company and I sell into New York and New Jersey, like our examples were, I might be able to use a certified service provider in New York and New Jersey, but I can't in Pennsylvania because I have physical presence in Pennsylvania. Streamlined sales tax program. People might wonder what the heck that thing is. Well, this has actually been around since March of 2000. Congress put this into place at one point. Then they backed off of it. It kind of got codified and actually put, gave function to it effective October 1st, 2005. This is basically an attempt by Congress to say that if a state will agree to be part of the streamlined sales tax program, then we will do, I think it was tied to funding for roads. But the idea is that you have to attempt to get all 50 states to agree on a uniform tax base, uniform sourcing rules, state level administration, and simplified tax rates. I mean, good luck with that, huh, Rich?
I mean, it was at least an attempt to get all the states assessing sales and use tax to agree on certain points, so that there would be some general points that you wouldn't have to look up
Right.
every point for every state you were doing. So I think the thought was there. I think it was a good thought, but trying to get 50 states to agree on anything is, I agree, is not going to happen.
Yeah, and this isn't the first time they've tried this. The Multi-State Tax Commission has been trying to do this for about 35 years, trying to get states to agree from these same types of things as income tax on the income tax side. So, I mean, just imagine this. You're in the office, there's 10 of you in the office, you all want to go out to lunch someplace, and you all have your own favorite place. How would you get all 10 of you to agree on the same place? It's a bunch of emails. It's a bunch of, well, how about this time we go here and next time we'll go to your place? Or you have to decide how you're going to do it. It's the same thing, so that's what you have to work to. So under some circumstances, the cost of using a certified service provider can end up being zero, but let me tell you, that does not mean it is free. The states are providing funding to encourage compliance, which actually means Joe taxpayer is paying for it. So it's not free, okay? You can see on this list here, I've just given you the same states we've been talking to. Out of those states, New Jersey is the only one who's a full member. What does a certified provider do? They basically act on your behalf. They actually can go in and they will register you. They will file your returns. They take care of all the administration side. So it says on that last bullet point, they actually go in and get a sales tax license for you. It's issued in the name of the CSP with you as the sub of that, or a secondary owner of it. Now, keep in mind that what that means is that you don't have to register yourself. Okay. Now, Pennsylvania has not yet addressed what happens if you change CSPs. So to that extent, if I am using a CSP and I don't have my own sales tax license in my own name and I change those providers, do I now have to register? Does that stuff transfer? Pennsylvania hasn't quite addressed that yet.
So the CSPs are basically outsourcing the function.
That is exactly it. Help, and some of the funding is being offsetted by the states in some cases. You really should look at your accounts payable, accounts receivable, your processes. Your business process improvement can be built in to help streamline some of your processes, may actually help, again, identify places where we can tweak some things, and maybe you don't have Nexus in a state now where you did. Maybe you put more Nexus into a state where you already have Nexus and take you out of states that have a higher sales tax rate. Again, lack of conformity within systems can help complicate systems, but that's a problem you have pretty much any time you have to update things. Please contact us if you have any of these situations. If you've already received notices from a tax jurisdiction, if you are getting a Nexus questionnaire, I call these phishing expeditions. They're trying to see what answers they're getting back, and think of it as a survey. They're compiling them and they're going, oh, maybe we need to look at this and tweak it. So look at where you actually make payments. You might be surprised how much one department in a company doesn't know what another department is doing. You might have a salesman who's out selling in Illinois and you're in Pennsylvania and you have no idea, the corporate office of the client in Illinois is actually in Pennsylvania. So every time you go into your AP system and you bill them, that drop-down menu comes out, you hit the first address, it's a Pennsylvania address. You as a person in AP may have no idea that their sales are actually in Illinois. So take a look at these things. Any kind of excise taxes you're paying, you want to take a look at those also. Listen, whether or not you decide to file under all this has to be a business decision. There are some times when common sense really still has to kick in, even though we're talking taxes. But you have to understand the risk. You have to understand your exposure. And you should document all of your decisions and why you are making them. I think the last thing I want to mention is there may be, and for some companies, there may be reporting requirements on their financial statements that don't have anything to do with what we've been talking about. It's just that now you have an exposure that you're not going to record or comply with, and therefore you may have an unreported tax position, or you may have a undisclosed tax or an income tax reserve that you should be filing for. Lastly, I want to make sure that you have the actual email addresses, not just for Rich and I, but for the certified service providers that Pennsylvania actually has agreed to use. Notice that all states don't use all the same ones. So you may be able to use one of these in Pennsylvania, and you may find you cannot use them in New York or California. So you do have to look to see. Efficiency hopefully would mean that you could pick one that's in all the states you're in. So that pretty much wraps up what we have here. I want to thank everybody for listening on this session. If you have any questions, again, please feel free to reach out to us. We're here to help you in any way we can.
Margie, we do have one question. We don't have enough time to answer it completely, but I think it makes a good point. Wayfair is a sales tax case, but do you think it'll impact state income taxes?
I absolutely do.
The concepts that they've introduced with Wayfair, will it creep into the income tax side?
So I absolutely think it will. I believe in 3 to 5 years, all the states will have same bright line test that they have for sales tax. If it works for sales tax and Congress doesn't overrule anything at this point, it makes sense to me because it's got to be infinitely easier to administer. California did it with 500,000 back in 2011. Colorado did it in 2012. Hawaii actually just did it, effective for next year. They put in a bright line test, same test they have for sales and use tax. They've put it in. So I do. That's a great question. Absolutely.
Okay. It's time for the third webinar polling question. So I'll launch that now, and I'll give you about a minute or so, and we'll get right back to it. Looks like we have about everybody has voted, so I'll close this polling question. And next up, we'll have Matt Haynes. Matt Haynes will be speaking to us about the internet security, data security. Matt is Maillie's Chief Information Officer and leads our firm's technology department. He has over 15 years of experience in information technology with a specialized focus in networking and security. Take it away, Matt. Happy Tuesday.
All right, thank you, Rich, and thank you for the nice introduction. So, good morning, everybody. Thank you for joining us here today. I mean, there's been a whole lot of good information shared, and as you can see in my title, I like information, right? So we're going to be talking a little bit about some information security tips that are not applicable just to IT people. So hopefully everybody on this call here will be able to get some benefit, and I think derive some opportunity for some different ways to think about things as we go through this. So let's talk about information security. So first thing I'd like to talk about is something that may be obvious to some, may not to others, but certainly after we talked about the complication of all of the different tax implications, if you go through the trouble of documenting all of that stuff, make sure you back it up, right? So backups are kind of important and will not only get you out of a dilemma that's related to an information security issue, but also to end user, mistakes or problems, or even to yourself. I mean, there are times that you may not intend to delete some files that you end up removing them. If you don't have a backup, it's really kind of difficult to recover from that. So I wanted to touch on this because it's really a core tenet of a lot of what we do from day to day is now electronic, and it's very quick sometimes to not really pay enough attention to this particular important tenet. So in my personal life, as an example, maybe I don't need to back up my stuff very frequently. It's nice to have a backup. I'll give you a personal example. I use an Excel spreadsheet for my check register. And I do write checks still. Some people find that surprising. Not many, but I still do write them on occasion. And so that data changes, maybe not very frequently, but at least, every week or 2 weeks, I'm writing a check. So when that occurs, I'm updating my Excel schedule. Let's say something were to happen with my computer. I was a victim of a ransomware attack, or I fell for, some type of social engineering attack, or let's say my computer just died. Something happened to it. I spilled water on it. It was a laptop, and it's not recoverable. If I don't have a backup, maybe in my case, it's not the end of the world. I can probably get the last year's records from my bank or something of that regard, but it's something I want to have and is important to me for record keeping. Now let's, so when I say what is important, maybe not everything on my computer is important. Maybe not everything that you have in a particular program is important. A lot of our customers use QuickBooks. We use software that's similar to that for a lot of the functions of what our firm does. So for QuickBooks, as an example, we may not want to back up the entire application because we could just reinstall that pretty easily. But the data or the information that's stored in the application is certainly very important. So we would want to make sure that that's protected and backed up. So, so in talking about what's important, I think it's best as an approach to just make a list. Maybe think about things that you're changing continually or things that are being touched by multiple people. The example that I was giving you earlier about my check register, maybe just setting a backup once a week or even once a month might be sufficient to recover my data if I lost it. But if I try to apply that once a week or once a month type of situation to some people here at Maillie, as an example, let's say we have a small team of people, maybe 8 to 10 people working on a job, and they're working on that job and sharing some documents and files through the duration of a week. I mean, they may be spending all day doing that. And so then multiply that amount of time and effort by the number of people that are working on that. Suddenly now a week backup or every month is certainly not sufficient to be able to recover that data from my perspective. I mean, it's just something much more frequent would definitely be a recommendation. It may be something hourly or even more frequent than that. So I kind of touched on how much do I need. That's a question not only in what specifically you need to back up, but perhaps how long you need to retain it. Um, so do you need to be able to go back a year? Do you need to be able to go back 2 years to look at something? That may be important in your particular circumstance. Sometimes how much do I need is really related to the fact that your data in some areas may change, but in other areas may not. Um, Good example is your documents. Maybe you have your documents really well organized on your system, and you're continually uploading or putting files in there that you're adjusting, on a daily basis. But then maybe you have another folder for just tax returns, as an example. You're receiving them once a year, so they're not going to change daily. Maybe you don't need to back them up as frequently. Those types of thoughts you need to think about. And of course, how quickly do I need to recover? This is something we're going to talk about, some backup methodologies and just touch on a few options that you have. But this is a question based on how you're storing your backups, right? So if I'm backing up my data and putting it somewhere on a USB drive, let's say a hard drive, an external hard drive, and then I'm storing it with, at another location or another office, maybe it's going to take the time to actually go to that location, get that hard drive and bring it back to recover. I mean, is that how quickly it's going to take? Is there enough time essentially for me to be able to be productive? If there's a big team of people working on that, perhaps a recovery needs to be quicker than that. So just start to think about these types of questions and these types of things. If you don't have a backup strategy right now, or you're not backing up anything, or you're not even sure, what I would encourage you to do, and this is something that I do with problems that seem like they're insurmountable or difficult, just maybe book some time off on your calendar in the next couple of weeks, like 30 minutes to an hour, and do that at two different periods, and then just sit down and start to think about how to do some of these things, because they may not be as daunting of a task to actually back something up successfully as you think. It may seem like you just don't know how to back up a QuickBooks file, and that's probably true. If you haven't done it before, it's going to seem like it may be difficult, and perhaps there may be a lot of considerations when you go into looking into it. But in the case of QuickBooks, it's very simple. You can actually go in and just do a file and backup, and then you can also configure a schedule. So once you sit down and play around with it and look into it, you'll find that it's not that difficult. So different backup methods here can put your information in various places. So there are two at the top of the list here, ways that you can back up pretty easily to a regular desktop or laptop. You can usually just put in a USB drive and copy your data, and maybe that's enough, depending on what you're doing. The third picture actually represents cloud services. So this is sort of a wide gamut of services. It could be a backup solution that is a pay-for solution that's specifically meant to back up files, where you tell it, all right, here's where my data is, and this is the frequency that I want it backed up. Or it could be something like, even on your iPhone, you might have some really important pictures or some information that you want to store. Just make sure your iCloud backup is configured. It's pretty simple to do, and will save you if you drop your phone in the parking lot and it gets accidentally driven over or something happens to it. I mean, certainly anything can occur, so you want to make sure that you have a good backup. So backup software, I also want to mention here that, and this is a picture from Windows 10. It's included in Windows 10. So you could just type in if you click on the start button and type in the search backup, this will come up, and you can see right here, one of the questions it's asking is to add a drive. So if you connected an external hard drive, you'd see some further options. So this is pretty rudimentary, may not give you a whole lot of options for setting it up and detailing a backup, but it might get you started and at least get you somewhere where your information is somewhat protected. So if you're not doing something as basic as this, maybe you should. Also, if you work with IT people and you're not too sure, it's always good to ask them about the backups. Check on that. Make sure that they have the right retention schedule. Make sure that they're backing the things up that you really require frequently enough. You also may want to test a restore. Sometimes it's nice to see that something's backed up, but until you've actually gone through the exercise of restoration, you may not know what problems could arise. So it's good sometimes to even if you're not restoring it back into production, to maybe just make sure, can I get the files? Can I look at them? Can I set them up on another system and at least view them? So those are things to be cognizant of and just to take seriously. I feel like at least here at Maillie, a lot of our recovery takes place just due to end user error. It may be myself just making some changes to even the slideshow presentation, and if I make a mistake and can't recover it, perhaps I could redo the information really easily, but sometimes it's really difficult, or there's a lot of information that has to be redone. So time is money. Certainly if you have a backup, it's nice. The last piece I want to mention is on most well, actually, two other things. For a Mac, there's a thing called the Time Machine that's built in. You can use that to back up your files. So if you have a MacBook or a Mac solution, it's already built in as an option that you can configure. And Windows also has a system called shadow copies. So shadow copies allows you to, if you have sufficient space on your computer system, configure an interval where it just stores like almost a snapshot of that particular file. And we find that very useful here. It's built into the operating system. You just have to configure it. So if you spend some time online and just look up shadow copies or ask somebody that's IT, you'll be able to do that. And it may save you a lot of trouble because you can just right click on your folders and go back in time, depending on how you have the policy configured, and just pull the files right back out. So all right, let's talk about ransomware, because this is something that is a reason that you may need your backups, right? So ransomware has been in the news and is something that a number of people that have become a victim of already, in multiple different sectors. You can be just an individual and have this occur. You can have a business and have this just, spread throughout your business. Governments, we've seen, the news pages about this. So how does a person normally become a victim of ransomware? It varies, but typically it's going to be some type of an email. Okay, so it's going to be some type of an email phishing link. It may be a website that you happen upon through, either an email or through a link from another website. But generally speaking, it's going to be something that you have to do that runs some procedure or code on your system. So how does ransomware work? Let's talk a little bit about that. Um, if anybody here has ever just compressed or zipped a file, zipping files is useful in a variety of different ways. It makes the file smaller, but it can also take multiple files and put them together. And normally you just, send those files to somebody and they can extract them or unzip them. But in some zip applications, you can actually add a password to them, and you can add encryption to it as well. And if you do those things and you send a zip file with a password and encryption on it, the recipient's required to put in that password in order to unzip or extract the contents. So think of that as a way that ransomware kind of works. It functions in much the same way, where it takes your individual files and it encrypts them, but it puts a special password that you don't know on your files. And so they might still exist on your system, but they're not going to be accessible. You're not going to be able to open them up and read the contents. And then they ask you to pay the ransom. And even if you do, there's really no guarantee that your files are going to be accessible. Many people have differing opinions on whether or not the ransom should be paid, but as I said, I mean, if people are infecting you with ransomware, I mean, if that's the type of person you're dealing with, what's any guarantee that they're going to actually allow you access back to your files? So how do I protect against it? We just talked about backups. That's one good way. If you have all of your files backed up, then you can recover. Now, I want to make a point to this too, because it's not just that you have your files backed up. It's that you have your files backed up and they're backed up properly against this particular threat. If you have, as an example, a hard drive and you have it connected to your system all the time and you're storing your backups on there and you become a victim of ransomware, it can be, possible for the ransomware to not only encrypt all of your files, but also all of your backups. So think about that and consider how your strategy is set up. So that's something that's a possibility. Now, not all the strains of ransomware will do that, but in a business, that's why this is so debilitating, because it's not just your local system that becomes encrypted. It can be any of the systems that your system is connected to. The last point here, I just wanted to point out there's a group online at this web URL, www.nomoreransom.org. You may want to check it out. It's a number of different organizations that have come together to provide tools and services for people that have fallen victim to ransomware. And there are some there's some utilities, I should say, on that website that allow you to just decrypt common ransomware strains. So they also give you some good tips. Some of them I'm sharing with you here to avoid becoming a victim of this. So this is another type of a scam that's not necessarily ransomware, but is a similar scam to infect your system. Now, this one, though, we've seen a number of people in our environment actually have this either in their personal life or even here at work. You'll get a pop-up message and it will say, your computer has been infected or it's been blocked or you have a virus. And this particular one shows a Microsoft error. That's very common for people to use that are maliciously trying to go after you. It's because Microsoft, everybody knows that word, everybody hears that and says, oh my goodness, something's wrong. And if you call this number, what ends up happening is somebody is there to console you and say, all right, well, we'll help. You just need to give us remote access to your system. And so you go ahead and do that thinking they're going to be helping you. And in essence, what they're doing is they're installing software onto your system. They're putting code on your system that is logging your information. So your payment methods that you end up using then might be siphoned and sent somewhere else. So some of these pop-ups can look very scary and can seem very scary. So I just want to make you aware of these things. I mean, they're just scams, okay? So don't fall victim of it. It's okay to just turn off your computer or go into Task Manager if you know how to do that and end task on that particular process. Some of these scams will also talk to you. In the background, you'll hear a recorded message and it'll talk like a computer robot and say your system has been infected. And that can add, a piece on this that just makes it even more real. And it's not just for Microsoft. You'll also see here, Apple has a very equivalent thing. And although, these screenshots are from computers, you can have the same thing happen on a smartphone or tablet. So turning on airplane mode or disconnecting is not a bad idea. If you see something like this pop up, close out of the apps. You may want to talk to somebody that is familiar with IT. Just maybe have them check the device. But in most cases, these are just scams. They're trying to get you to call somebody. So you might also get telephone scams. Microsoft is not going to call you. They're not, they're not going to tell you your computer is infected with a virus. That's sometimes a technique that scammers will use. They'll call about viruses or licensing, or even that your warranty is expired. And that's what they'll say, and they need to get onto your system and check some things and renew some stuff. So it may just be a cold call. We've seen this not just with technology, but with the IRS scam calls. That happens all the time. We have our clients will tell us that they've gotten a call from the IRS. It's just these things are meant to scare you into providing your personal information. The last bullet point I was going to mention, because this is just something I know has happened in Pennsylvania, but local police have become the victim of some scam techniques where the caller ID is changed instead to the local police telephone number. And so it appears like the police are calling you, and it's actually their number that appears on the caller ID. And they've issued, notices to in some local jurisdictions that said, listen, we're not calling you. If the police want you, you're going to know. We're going to just be there at the door. So, they're not calling you. They don't want to get, your personal information. You don't have to share your social security number. I mean, just take those things with a grain of salt. If you hear somebody calling you, know that it's probably a scam. Now, we talked about ransomware scams, how you can get them. Here's an example of a link that was sent. This is supposed to show you or depict that we're hovering over the link here, and you can see that's our website, but if you hover over it, you can see the URL here that it's taking you to is different. So this is commonly used by scammers as a way to mask or hide what they're trying to do. Now, obviously, you can't hover over a link on your actual smartphone or your tablet, but you can just type in the website. So if you get an email from your bank, maybe just go to your bank URL and log in rather than click the link. It's a much safer alternative. Another just small point I'm going to point out is if you're getting files here sent to you through email, in this particular example, on Windows 10, you can go to the View tab and show your file extensions. You'll see in the highlight here that they're not showing, and there's 2 files in the list. The second file is actually not a text file, and it's listed as an application, but we can't see the extensions truly here till the next slide. You can see now we've enabled the setting to show the file extensions. And the first file is actually a text file. The second one's an application. So sometimes you'll get a file sent to you, and if it doesn't come from a source that you recognize, I mean, just really closely inspect that file because it may be malicious. They may be trying to get you to run something that's going to infect your system. Another point is updates. Keep your systems up to date. That means if you're running something old, like let's say you're running Windows XP, consider getting rid of that. It's long past its life cycle, so and don't keep pushing off your updates. As your phone or as your device prompts you to update, go ahead and do that. It helps keep you protected and helps keep you able to be supported. So some software vendors won't support you if you're too far back with your updates. The other point I just want to make is a lot of the web URLs and logins that you have, if you don't have a strategy for managing your passwords, you should consider using a password manager or password wallet. And this will help keep your passwords unique for each site. And that's important to not reuse a password. So you can look this up online, and it really makes your life a little bit easier. And with that, I'm going to kind of wrap up my presentation here. Thank you all for your attention and for listening to us and for joining us today.
Very good. Thanks, Matt. We did have an online comment about we also consider that Amazon on the list of possible scammer accounts. One of the attendees mentioned that the scammers hacked into their Amazon account, put phony charges, then called to offered assistance to fix the problem. Of course, they wanted access to my computer. So there's a lot of bad characters out there looking for access to our data and ultimately our wallet, I would imagine.
That's right. And they use various techniques that try to make you feel pressure. So if somebody is really pressuring you into something, you have to, in the back of your mind, question why that is. And most of the time it's because they're trying to get you to turn something over just flippantly, not, think about it or consider what the ramifications of doing so would be.
Very good. Thanks, Matt. At this time, I'm going to do our final webinar polling question. I'll give you about a minute or less, depending on how fast people vote, and then we can wrap it up and conclude today's event. Okay, it looks like we have all the votes we're going to get, so I'll close this. So this concludes today's webinar, but first I would like to thank today's speakers and all of you attending online this morning. We hope that each of you found something of value from our discussions today. We gave you some things to think about regarding cryptocurrency, state taxes after the Wayfair decision, and tips to help keep your electronic data more secure. Please remember to complete the survey to qualify for your CPE credits. The survey should launch at the conclusion of the webinar. CPE certification will be emailed to the address that you used to register for today's event. If you have any questions, please feel free to contact your Maillie representative. Thanks again, and I hope you have a great rest of the day.